We always love speaking with Samir Arora. He brings a fresh perspective to what is happening right now, and he's, of course, founder and fund manager at Helios Capital. Samir, very good morning to you. Now, a couple of things that we want to unpack. Of course, our special coverage where on the 75th birthday of Prime Minister Modi, we're taking a look at the impact of policy and governance. There is a political and policy moved style to what Prime Minister has brought to the table since the last 11 years. What is the kind of impact you think you have seen on business, on economy and on capital markets?
Well, on the capital markets is easy to see because we are beneficiaries of that, which is the fact that so many investors have come into the market. And although you may say that the investors, what specifically was done is was the ease of doing things online or digitalizing things. So you can see in the mutual fund industry where, say, we are one of the recent entrants and suddenly out of nowhere, without having to set up our own infrastructure, people can go online and buy. And all this has been enabled by the fact that it was easier because of Aadhaar, because of bank account, because of people becoming comfortable with digitalization, that they could do these things online on their own. So I can see that as a big picture, immediate or a direct impact on capital markets. Now, if you say on economy, I would think that the biggest one might be, if I think about it, maybe the fact that a fiscal deficit throughout has been kept sort of in control. And the main test of that was the COVID time, where many countries have been put off course. You can see the US having their fiscal deficit go from some, I believe, 3.5% to 7% right now. And India might be one of the few countries where the deficit is below 2020 March or pre-COVID levels. And that has helped in a recent upgrade, but more than that, given room for private sector and otherwise in general to have a healthier economy where the government is not crowding out everybody else. So big picture, if you say in that sense, although if I think about it, there'll be GST and there'll be a few other things which are there. But for capital market, that would be the biggest. And for economy, I would think in a big picture sense, the fact that private sector has been allowed to grow and not be crowded out might be the biggest.
Samir, you fear that is happening?
Which is?
The private sector crowding out?
No, not private sector being crowded, because it has not. Indian deficit has not increased. So we have been saved from that.
Yeah, okay, fair call. Sorry,
otherwise, you can see what has happened to the US dollar itself, which has blown up by 12-13%. And Ray Dalio's writing a book on how nations go broke. If our deficit had become 7-8% instead of 4%, which in that 1 or 2 year period that everybody was doing after 20, then it will be very, very difficult to get it back online.
Yeah, which is why I think that the red line, that the GST conclave, the FM reiterated that 4.4 is sacrosanct, nothing doing with that. Everything else can work around it. Okay. Samir, I presume you just came back from the US, right? About a couple of weeks out there. If anything, aside of the GST reforms, the most important thing on everybody's minds is how is it that, the relationship sees a thaw? And what is it that maybe, large global investors might think of it as well? You are a large global investor yourself, and you have large global investors in your funds. Give us some insight.
Getting a few more, by the way. The good news is we might get, touch wood, 1 or 2 more in a few months too. So the point is, I met them last week when this thawing was not fully done. Fortunately, yesterday, day before, we can see these tweets, which look very nice. But actually, last week also, that first round had happened where I think Mr. Modi had responded to Trump's talk somewhere that, our relationship is good and I like Prime Minister Modi personally and all that kind of thing. So after that, when Mr. Modi had responded, that had happened. So we were telling that story that don't worry, this is the bottom of the relationship or the peak of this harmony or whatever. But in general, because people even otherwise did not believe that the 25% additional tariff, which was only put on India, and then one lady said, no, it's been put on Brazil also, that they are also at 50. But anyway, so that 25% extra everybody thought was sort of temporary. Therefore, that was not the main issue. I think we were only from our point selling that, see, we generally, India as a market has done well over the long term, even 5 years, and last 1 year and year to date difference is too big. This catch up will happen. And even though all these guys claim to be long term, they also want us good sort of entry where you don't wait 1 year to be proved smart. So all these things are working. Plus, in India's case, the thing is, it is easy to say that this slowdown is happening because of one sector, which is the IT sector, and either IT sector has to become cheap or it can be ignored forever, as far as I'm concerned. So we were saying just look at where the growth is and don't worry in aggregate, because the aggregate one sector does has been affected. Plus, many people, not me as much maybe, but many people feel that the AI boom has gone on too long, or that it's very speculative, and there'll be some X% people who will want to play the rest of the world. Currently, Korea, Taiwan, and US are doing well, basically because of people betting on AI. And then there'll always be a crowd which says that either it's overdone, or they would like to diversify, or they want to be more balanced. So India will continue. I've been telling India will get its FII flows. There's nothing to worry on that. It might be less or more, but you will not have negative flows when every other country is getting flows, basically being diverted away a little bit from the US.
So, Samir, I wonder sometimes if we are able to look objectively at what India is seeming like from our lens. Because the fact is that the kind of results that we've seen, or corporate growth we've seen so far in the last couple of quarters, has been below par. Do you see that changing with this GST push, with tariffs easing, etc.? At the end of the day, corporate performance is also needing to keep up.
It will, because simply if you look at the three pools, one pool is financials. And the financials, which are dominated by the big banks, they have had a below 10% type of growth because of interest rate cut and NIM compression, which they themselves are saying, and everybody agrees that that is a matter of 1 or 2 quarters, that from next year, because this becomes stabilized and the interest rate cuts up pass through to the deposits and all, that over time that NIM goes back. And generally the thumb rule is that the financial sector or the banking sector grows about 1.5% to 1.7% of GDP in nominal terms. So you will get back to that 14-15% growth. I'm only worried about the IT sector, but the IT sector today weight is about 10-15%, because they are not going to grow 15% like, or even higher than they used to grow in the past. Maybe they grow from 3% to 8%. So that compression will be there. But even the consumer sector now, whether it is one-off or it is catch-up or it is pent-up, but you're going to have a massive 1 or 2 months starting on whatever 22nd, and then this thing feeds on itself, because then you move on with life and there is a cycle that starts. And my general rule is that these growth rates and slowdowns don't happen for a quarter at a time. Once they start, the positive spiral starts. And similarly, if there is some, or not similarly, but in parallel, if there is some reduction in the pressure on India-US relationship, and the 25% extra is removed, the extra tariff, then that also will start. Maybe it'll be a little lower than before, but definitely higher than recent expectations. You have seen that already in the textile stocks, which we used to also own, we still own, which was down some 35%, and now this month is up 22%, but of course still down. So all these things will start again, and the pressure on jobs and salary cuts. I heard today that one company has made 25% salary cut across the board for because of US impact on exports, and or pressure on exports, and all these things will then normalize if these things get sorted out. So you will have higher growth than this year, I think, for sure, and then we see how it goes. But also, please note that if China is up some 60% and we are up 1, and emerging markets are up 25 and we are up 1, then our relative valuations have also a little bit corrected, right? Which was one of the issues in the past.
So people will stop saying expensive market. Okay, I just want to get your view, Samir, of all the excitement in the primary market. And we're talking at a time when there is, I would say, a monster hit of a debut. Of a platform company coming in, mid kind of a response to another consumption-facing company. You think that IPOs could give clear value to investors, or you'd stick to the tried and tested, stay away from IPOs no matter what?
No. IPOs will not give any value. IPOs are doing well because some previous 3 IPOs, after falling 75% from there, have done very well. And therefore, the world feels that, oh my God, this trade is too easy. It is not at all easy. And you can't start and then go up 50%. And if your profits have been there 1 year, you need to see that path. But there is that initial pop that normally happens in a very good market. But after that, to buy it 50% higher, by the way, our mutual funds are anchor in this company that you're showing. But I would say there is no question of anybody buying it from our company today, or then it has to settle. It has to at least for
No,
one.
but you are anchor investors, so let's talk about the merit that you saw.
That's what I'm saying. I'm saying there are two elements in that. One is that the anchor is 33% lower than what it is today, I believe.
Okay.
And it's up 50% or whatever. So that is one. Second is that you get in a little bit initially to sort of follow it properly. But when you are, because that position, by the way, when you say anchor, it looks like such a big deal. But even for a very small mutual fund and a very small allocation, it'd be like 0.1% or something, or 0.2%.
Writing
So
about the
that,
size of the allocation, seeing the response right
because
now,
the
and of course we're talking
allocation
about
for
urban
everybody,
company here, to be clear.
for allocation for everybody, even the big guys, because their AUM is big, even for them, the allocation as a proportion of their AUM is 10, 15 basis points, right? But when you can buy in the market, you can straight away buy if you want 1.5%. And that needs a little bit different, this thing in terms of it's settling down and being at a price which you are comfortable with, for then holding it forever, or for at least, next many years or 2, 3 years. So that takes time, and that we will see.
Okay, in terms of pockets of value, and we've spoken in the past about platform companies, do you see this as a continuing uptrend as people have more discretionary expenditure and those possibilities? Where does that money get spent?
It has nothing to do with discretionary expenditure, because that then they can buy anything. It is to do with the fact that their mode of spending that money has changed. So when you are talking about food delivery and maybe quick commerce, it's not that people have discretionary money, so they are spending more there. It is because they are choosing to use that channel instead of some other channel. It is not that the end growth has gone up a lot. When you are buying insurance online, it's not that you are buying more insurance. You are just buying it through online instead of buying it through an agent. If you are using money and paying, if you are using cash and paying through a phone or a phone app, it's not that you're spending more money. It's just that you're not spending physical cash. This is easier to imagine, easier to understand. The convenience is easy, but you're not still making any assumptions about end demand and people spending more on these things. No, no, no. That bet would be a different bet. That is the bet which is more confusing, because you may say that the end consumer growth is not there, that new jobs in IT are affected, that, the issue with otherwise the negative part in some sense that there is not enough jobs. So that if you're betting on higher jobs, higher absolute consumption, that maybe GST triggers it, but not the platform companies. Platform companies are just basically proving to you that some things have become more convenient way of using or buying, and that is why people are going there within the same pie.
Samir, your fund are giving remarkable returns. Now, what is this? Is this a change of strategy? Is it the fill it, shut it, forget it, done for the past, but you're doing more nimble? What is it? Since inception,
By the way, just for
Helios
information,
MF.
although our fund is 1 year old, I've been coming on your channel for 20 years, and I've been a fund manager for 30 years. And actually, the 30-year information is available publicly.
Yeah.
Our performance in the past, when I was fund manager or when we were managing or still managing the long short fund, and that's only a long short fund, it is all available publicly. So it looks odd to keep talking about 1 year performance. You should look at our 30 years and compare to every fund of India, not just.
Okay, no, Samir. Okay,
so what I'm saying is, I'm not going to answer it because it makes it look that we have just suddenly come and bought one Zomato, and that is the reason.
Samir, your credentials don't need to be explained.
Okay, fine.
It has been answered for 30 years.
Okay, fine. Fair call. No. So see, Samir, I remember a year and a half ago when we met in Singapore and then you came on air, we spoke about that idea too. Just because this strategy is new for retail investors, somehow retail could never subscribe to your funds earlier.
We've been basically saying that you don't know exactly whose turn it is next. You buy 30, 40 companies, of which 20 will do plus minus same as market, and 10, 15 should do much better, and some will do much worse, because you cannot totally avoid, and don't be embarrassed about it.
Yeah.
But this strategy has been working in our PMS since 2011 and my long short fund since 2005 and before that in Alliance. And it seems to have worked in every slightly longer or even literally every year. So it depends, not literally every year, but broadly very high
Got it.
frequency of beating because we are not taking big bets and we are also different in the sense that we don't believe that you can buy a 20-year or a 10-year story straight away because not only you don't know, the managements of those companies don't know anything. Just to leave one line that the Netflix guys went to Blockbuster and tried to sell Netflix to them for $50 million. And the Blockbuster guys refused it. And now that is worth 500 billion. So if the promoter, the owner, the founder of the company did not know how we can buy something for 20 years and say that we have bought it and filled it and shut it, no. We can buy that stock these days, but we used to have this ad.
Yeah, no, having said that, Samir, the 30-year record shows that, you have a knack for picking those winners. And it's not as random as you're making it out to be. So,
we are making it as an educated guess, or guess is a maybe.
so what is the guesstimate right now, or the educated analysis right now? What are the ideas that you're finding interesting? Leave us with a nugget.
No. See, that portfolio is public in India. Mine will be plus minus similar here. But the point what I'm saying is we don't know exactly, but we know that if you buy a bunch of or 10, 15 stocks, some of them will do very well because the common factors are there. But you can't literally talk about any one stock because sometimes that stock doesn't work. And therefore, if you see our portfolio, we'll have 2%, 1.5%, 2.5% in maybe 20 names. And out of them, then sometimes they work disproportionately. Like this year, car trade worked, and then Aadhaar worked, and then Ola worked. And Ola also worked a little bit. Paytm worked, and Zomato worked. But sometimes some of them won't work. But you're not, even then, we keep talking about these stocks. But if you see their weights, you can see them in the domestic portfolio, they'll be like 2.5%, 3%. People get very upset that how, if you knew about this stock, why, and you knew this stock was going up 50%, why didn't you buy more? Because we didn't know it will go up this much, but we know as a bunch, enough of them do well, and then some of them don't do well. So don't be embarrassed about it with some, people who commit too much investment to one name, then get sort of tied into that name. We tell everybody that some of them will not work, and we'll be happy to move them to some other name without any embarrassment and any explanation.
I think that's interesting. Don't be embarrassed about what doesn't work, and don't crow too much about what works. I like the Samir Arora formula, the way of thinking. Thank you.
You can see that simply from the weight. You see the noise that is made, say for our Zomato, but if you see its weight in the mutual fund, it'll be 3.5%, 4%. Now 3.5% for somebody else might be their tail stock. For us, it is our great, well-publicized stock, which has, at least for the older fund.
What is the one bet which is not so well publicized?
No. Actually, there were many like that which suddenly happened because Aether, we were in the anchor and that was one of the ones we bought later and it is up some 70% in less than a year. That way even car trade is up maybe 150, 200%. But our weights are small. That is the whole game. Yeah. The game is that no one stock should prevent me from watching Netflix in the night.
I don't think anyone prevents Samir from doing anything he wants to at any time of the day.
If it's a big position and it falls, then you can't watch.
I don't think anything disturbs your peace of mind. Well, to that, thank you so much, Samir Arora, for speaking with us. Always a pleasure.